Price is BS. Yep, you heard that right. It's a number, wait a few minutes, and it will be a different number. But Seth, how can you say such things? Current asset prices reflect all available information. At least that's probably what you've been taught, right? What I'm talking about is the efficient market hypothesis. It's the theory that current asset prices reflect all available information, and therefore beating the market is impossible. The efficient market hypothesis is one of the cornerstones of traditional finance, and it's also wrong. At least that's what the most recent research we have seems to be suggesting. What, you didn't think I came up with all of this stuff on my own, did you? No, I'm not that smart. It took countless researchers at our most prestigious universities decades to figure this stuff out. What they've discovered, though, not only demolishes the efficient market hypothesis, but answers some of the most controversial questions and contradictions in finance. What is the source of excess volatility? Why do markets trend? Why don't markets always follow the news? What I'm going to present to you today is a new understanding that allows us to see the matrix, if you will, and illuminates a path forward for traders to find an edge. So I hope you're ready, because this is truly mind-blowing stuff. So let's talk about the inelastic theory of markets and how orders move price. Hi, I'm Speculator Seth, and welcome to my channel where we experience the front lines of the financial markets together, and I'm just going to get straight into it today. So the study I am primarily pulling this information from today is called In Search of the Origins of Financial Fluctuations, the Inelastic Markets Hypothesis by Xavier Gabaix, a researcher at Harvard University, and Ralph Koijen from the University of Chicago. For simplicity's sake, we call these two GK. There is also a supplementary paper by my favorite researcher, Jean-Phillipe Bouchaud, I hope I'm saying that right, called The Inelastic Market Hypothesis, a Microstructural Interpretation. His paper links Gabaix and Koijen's work to what we know about market microstructure and order flow. So not only is this information coming from highly qualified sources, frankly, the most qualified sources there are, but it is also very new. GK's study came out in June of 2021, and Jean-Philippe's paper was published in August of 2021. I've basically been obsessed with this subject, incorporating it into my own trading for the last 6 months. So I'm going to do my best to summarize the research and its implications for us, but I'd highly recommend reading the actual papers yourself. They are freely available on archive.org. That's arxiv.org. The X is supposed to be like a Greek letter chi, so it's pronounced archive. You get it? Anyways, Archive has an awesome quantitative finance section that I check every week for new papers to read, especially that market microstructure and trading section. So in their paper, GK look at one of the longest standing questions in finance. If markets are informationally efficient, that is to say that current market prices accurately reflect all available information, then why do asset prices move around so much? The actual fundamentals don't change that much, but price is always changing. This discrepancy between the frequency of changes in fundamentals and the amount of volatility markets exhibit is called the excess volatility puzzle. Such discrepancies simply cannot be explained in a purely rational world. So several decades ago, researchers started to introduce irrational agents into their models. This is where the idea of noise traders come from, actors that are uninformed and are using strategies that are essentially random. If the actions of uninformed and random trades have an impact on volatility, then we can explain the excess volatility puzzle. It would mean that order flow is the main driver of price changes rather than fundamentals. Orders move price, even if there is no informational content behind those orders. But can we prove it? And this is where Gabaix and Koijen come in. So I'm just going to quote from their study here because what they say is so concise and perfectly explains the significance of their results. We start by asking a simple question. when an investor sells $1 worth of bonds and buys $1 worth of stocks, what happens to the valuation of the aggregate stock market? In the simplest efficient markets model, the price is the present value of future dividends, so the valuation of the aggregate market should not change. However, we find both theoretically and empirically, using an instrumental variable strategy, something they explain in a separate paper, that the market's aggregate value goes up by $5. So hold up. Investing $1 in the stock market increases the valuation of the total stock market by $5. Just pause for a moment and appreciate how crazy of a result that is. They go on. In contrast, most rational or behavioral models would predict a very small impact about 100 times smaller and a price elasticity about 100 times larger. This high sensitivity of prices to flows has large consequences. Flows in the market and demand shocks affect prices and expected returns in a quantitatively important way. We refer to this notion as the inelastic markets hypothesis. Wait, I didn't explain what price elasticity is. Let's backtrack a little bit. Price elasticity is a measurement of the change in the consumption of a product in relation to a change in its price. In other words, if price increases, less people will want to buy. Almost like a rubber band that holds price back. Except that we're saying that in stock markets, price is inelastic. The orders are so strong that any kind of rubber band just gets busted, and hence we've seen value investor after value investor get left behind or completely run over in the era of low interest rates and quantitative easing. The order flow created by these policies is so strong that anyone trying to maintain fundamental value just gets plowed through. The amount of money moving into the market from people contributing to their 401ks, government stimulus, and other similar forces will simply dwarf anything else. And this is why I contend that price is BS. The inelastic market hypothesis implies that the current price doesn't really mean all that much. It's not an accurate reflection of fundamental value. Instead, it changes according to the whims of current order flows, which makes trying to hold the market to some sort of probabilistic rule about where it tends to turn becomes a foolish proposition. If the impact of orders is enough to move price away from fundamental value, then it can certainly move price through some sort of line drawn on a chart. We end up with a market that is inefficient in a long-term informational sense, but relatively efficient on a short-term statistical sense. It's just too easy for orders to arbitrage away any intraday statistical aberration. So take your Bollinger Bands, MACDs, RSIs, support and resistance, and practically every other kind of analysis trying to predict future price based on the past price and throw it into the waste bin. They're all based on a false premise. I'm not saying that price doesn't matter at all, but just trying to analyze a single price time data series is unlikely to get you very far. We've always known that retail traders don't have much success with such methods, but now we have a good explanation of why so that we can stop wasting time with technical analysis. The future orders are what matters, not price. Unless we have information that is likely to lead to future orders, we have no trade. It makes no sense to try and trade these short-term patterns. That will lead to random results. We have to become informed traders. And this is where so many of the mysteries and contradictions in finance are suddenly resolved. Markets are volatile because orders move markets, and there is always a constant stream of orders hitting markets. Trends occur because the drivers of order flow can persist for long periods of time, days, weeks, even years. And markets don't always go the direction the news and the fundamentals suggest they should because the orders are what matters. If market participants misinterpret the news, their orders will move markets in that direction anyways. So markets can be just completely wrong about things. And some moves really are just random. It was just a coincidence that some big fund was rebalancing that day and moved the indexes. But the best part about this research is that the inelastic market hypothesis doesn't just debunk many popular ideas about how markets work. It provides a way forward, one that market professionals have been using for decades already and could potentially be incorporated into your own trading. Bouchaud clearly lays out our new objective in his paper. The idea that it is the order flow that must be predicted, even if uninformed, resonates well with the intuition of finance professionals and allows one to understand why statistical regularities might exist and be exploited by quant firms. Indeed, flow data is quite popular among statistical arbitrage funds. In other words, we want to predict order flow. But how do we do that? And GK gives us the answer. As a result, one can replace the dark matter of asset pricing, whereby price movements are explained by hard to measure latent forces, with tangible flows and the demand shocks of different investors. But the researchers don't just stop there. They give us a list of such flows and demand shocks for potential future research. And here they are: changes in belief about future flows or fundamentals. Liquidity needs, for instance, insurance companies selling stocks after a hurricane. More generally, heterogeneous income or wealth shocks to different groups, including foreign versus domestic investors, changing the effective propensity to invest in stocks by the average investor. Corporate actions by firms, such as decisions to buy back or issue shares. Shocks to substitute assets, which might, for example, prompt investors to rebalance towards stocks when bond yields go down. Changes in advertising or advice by institutional advisors. Roadshows in which firms or governments try to convince potential investors to buy into a prospective equity offering or privatization. Mechanical forced trading via delta hedging, whereby traders who have sold put options and continuously hedge them need to sell stocks when stock prices fall. Now that's a decent list that will only get longer, and each one of these forces could become their own research paper. However, that still gives us a great framework to base our own trading on. We need to become informed traders that understand as much as possible about the current market forces that could bring new orders. This list is the perfect starting point for identifying what kind of information can potentially inform our trades. This is why at the start of my trading day, I always go through what flows I expect to see that day. If I see a flow that I don't expect or understand during the course of the day, then I try to discover what the driver of that flow was. Then we discuss what we're seeing on the stream and in Discord. We're trying to verify or falsify our theories about what forces are currently working in the market. What gets me so excited about this newfound knowledge is that it's only the beginning. There's still plenty of unknowns to research, something that is just too big for any one of us. But that's why we have this channel. We've successfully created a community that can work together on this puzzle. So what do you say? Are you ready to stop wasting your time on noise trading and start working towards methods based on informed trading? Let me know in the comments. We have this huge list of potential research topics. Tell me which ideas interest you the most, and maybe that can be a future video. In the meantime, if you haven't watched my series on order flow, it has a ton of information that is relevant to this topic, especially my video on the stylized behaviors of markets and market microstructure. So why don't you give that one a watch? I'll link it over here, and I'll catch you every weekday morning starting at 8:20 Eastern time for the live stream. In the meantime, stay profitable, friend.